All right, let's talk about a process that can literally make or break a company's financial health: credit and risk management. We're going to explore how switching from old school manual guesswork to smart automation can be a total game changer.
So, here's our roadmap. First, we'll dive into the big problems with doing things the manual way. Then, we'll look at the data-driven solution, see how automated rules and monitoring give you back control, and finally, we'll get to the best part, the huge financial payoff.
Okay, so first up, the manual risk problem. The thing is, when you're managing credit by hand, you're leaving your company in a really unpredictable spot. And frankly, you're exposed to a ton of unnecessary risk.
Now, let's just get on the same page. At its core, credit and risk management is all about making sure that when you give credit to customers, you're doing it in a controlled, consistent, and financially smart way. This is really the foundation of a healthy cash flow.
But here's where the manual approach really falls apart. Decisions often get made with just bits and pieces of information. They rely on gut feelings instead of structured evaluations. And maybe worst of all, they use data that could be weeks or even months old.
And the results of that? Well, they're pretty much exactly what you'd expect. You suddenly have way more credit exposure than you're comfortable with, you see more and more late payments, you're writing off more bad debt, and your cash flow, it's just all over the place. But the good news is there is a much better way. So let's jump into our next section and see how a data-driven automated solution can completely turn this whole process around. What we're talking about here is a huge fundamental shift. You go from a process that's chaotic and really subjective, often just based on one person's judgment, to one that's structured, objective, and driven by actual hard data. It basically turns an art into a science.
So what kind of data are we talking about? Well, an automated system pulls together all the crucial pieces of the puzzle. Things like a customer's financial stability, their payment history with you, data from credit bureaus, what industry they're in. It even looks at their total outstanding exposure. You get a complete 360-degree view.
And then the system does something brilliant. It takes all that complex data and boils it down into something super simple and actionable: clear risk categories. So you know right away if you're dealing with a low-risk, medium-risk, or high-risk customer. And the outcome of all this? You get to stop guessing. With this kind of approach, your team is making truly informed decisions every single time because they're backed by a full analysis of everything that matters. Okay, so you've made a great, informed decision. Awesome. But how do you keep things under control from here on out? Well, that brings us right to our third section: automated rules and continuous monitoring. See, automation lets you build your company's credit policy right into the system. That means it systematically enforces credit limits, it sets the right payment terms based on risk level, and it handles all the approval thresholds automatically. Say goodbye to manual slip-ups. And the system keeps that control locked in. For example, if someone tries to change a customer's credit limit or their payment terms, it automatically triggers an approval workflow that goes straight to the right risk manager. Nothing slips through the cracks. And remember, this isn't a one-and-done check. Automation is always on, providing continuous monitoring. The system is constantly watching for any changes in customer behavior, keeping an eye on overdue invoices, and looking for those little early warning signs that a customer's risk profile might be changing. And where does all this amazing information live? It's all centralized in risk dashboards. This basically becomes your mission control, a single source of truth where you can see the health of your entire credit portfolio in one glance. So what are you seeing on these dashboards? Well, everything that matters. You can see which accounts are high risk right now. You can spot trends in your AR aging, check your total exposure levels across the board, and even identify any customers who might be heading for a potential default. Now, having this level of control and visibility leads us straight to the final, and let's be honest, the most important part: the real, tangible financial payoff. This is where we get into predictability and protecting your profits. Because you can actually see risks as they emerge on your dashboard, you can finally stop being reactive and start being proactive. You can adjust credit strategies on the fly, and crucially, you can prevent revenue leakage before it even has a chance to happen. I mean, this chart really says it all. The impact on bad debt is just dramatic. When companies switch from manual to automated processes, they see a huge, measurable drop in the amount of money they have to write off. It's a massive win. And of course, that directly impacts your cash flow. You go from a situation where cash collection feels erratic and totally unpredictable to one where it's smooth, it's stable, and it's reliable. And that's the dream for any finance team, right? So at the end of the day, automating credit and risk isn't just about fixing one little piece of the puzzle. When you do this, you actually strengthen the reliability of your entire order-to-cash cycle from beginning to end. Which really just leaves us with one final question for you to think about. When you look at your own operations, you have to ask, is our current credit process actively protecting our cash flow, or is it maybe unintentionally putting it at risk every single day? Thanks for watching.